But 1 minute to almost there. Okay, we are live streaming.
Right, we'll go ahead and call Genesee County Retirees Healthcare Plan and Trust to order. Madam Clerk, would you please take roll?
Elguire,
Present, Clio, Michigan.
Brandon, Gorman, Gorman,
he's unmuting.
I see him.
I thought I heard him.
There we
There
go.
you
Sorry,
Okay.
Flint, Michigan.
Potbury,
You're muted, John.
Present, Flushing, Michigan.
Simpson,
Present, Genesee County, Michigan.
Young,
Present,
Oh.
Flint and Genesee County, Michigan.
Galida, Pepin.
All right, we do have a quorum here. I thank everybody for coming. At this time, we have time set aside for public address to the board. Have we received any phone calls, requests, emails, anything like that, Jennifer?
We have not.
Is there anybody in the audience that's wanting to address this board?
No, there is not.
All right, great. We'll move on. New business, item number 1, LSIA transition, and I'll turn it over to Chris.
Thank you. And thank you everyone for making time today. I know we're not usually scheduled to meet this month, so obviously it must be an important conversation we're having. I'm going to share my screen, if that's all right. And hopefully that popped up for everyone. I see a couple nods.
Yep.
So late last month, I received a phone call from Kevin Youssef, who is the portfolio manager for the LSIA low vol strategy in your current portfolio. And you can see I have that listed here. It's your only equity manager for the VEBA fund. And he informed me that he was transitioning out of LSIA and forming his own firm, Youssef Capital Management, or YCM. And that was really the extent of the conversation, was that he was just kind of letting me know. About a week later, then he followed up with a formal letter from LSIA and him, YCM, kind of outlining this separation between the two. And so their intent at this point, and I will tell you, it's still kind of unfolding. I think we know probably about 80 to 90% of the details, but there's still some things that are works in progress there, is that Kevin and his entire team that was responsible for managing all their passive strategies. So those are the index-oriented strategies where they would follow a benchmark, are departing LS and forming this new firm, YCM. LS, in that notification to us, informed us that they will not be able to provide the services we're currently getting. So we really don't have an option of staying with the incumbent. We do need to make a change. And we have a couple options. One is we would be able to follow Kevin and continue using the strategy that we currently have. Or we could look at some other strategies, and I've actually put together a little report for you for this fund. And I guess maybe it would help if I took a step back. I think several of the trustees have been around long enough that they know some of the history of the VEBA. I also know some of you are new and really don't have much of the background. Years ago, and when I say years, I'm talking maybe 5 years ago or so, the portfolio was invested to generate income. And so there were a number of strategies that were all kind of income producing. And the thought was that if we could generate enough income from those strategies, it would cover the current expenses of the retiree health care. Unfortunately, it did not cover it. And at some point, we started spending more money than we could generate in income. And the total fund balance started declining. And we were roughly 40 million back then. You can see we're now around 10. And we've dropped, down into the single digits on the million side over the course of like last year and the year before. At that point where we saw that this was kind of on its way down, we took a different format. As opposed to being income oriented, we went to kind of a very conservative format. And so we moved out of some of the riskier strategies that we had in the portfolio, like high yield. And then we also had a REIT strategy where we're just investing in real estate investment trusts. That was our only real equity oriented strategy. And we moved to kind of core fixed income and that low vol strategy as a way of kind of continue to be invested, but taking a little less risk as we were kind of slowly working our way down. We used the term glide path, basically going towards zero because we weren't sure of the future of this fund. In the last year or two, it has become a little bit more, our understanding is that this will be an ongoing entity, at least for the time being, and that the county does continue to plan to make contributions to it. I'm not sure if we're going to see a whole lot of growth from the fund, but the idea is that it's going to be an ongoing entity for some time. And so the investments should kind of mirror that. And so when we look at the little report I put together for you, I have a couple strategies for your consideration. One is the low vol strategy that Kevin's currently doing on your behalf. The other one is just an S&P 500 index fund. Excuse me. And the one that I'm profiling here is actually managed by World Asset Management, the custodian for this relationship. So they could offer asset management and the custodial services. And generally we get a little bit of a fee savings by doing that. Little difference in the two strategies. The S&P 500 literally is going to try to mirror the S&P 500, the actual index. So it holds, 505 stocks. A couple of the stocks actually have multiple share classes, and that's why you see it's a little bit over the 500 number. And examples like Google, they have a couple share classes, and they actually hold both in that index fund. And the low vol strategy is a little bit different. What the low vol strategy is mirroring, it takes the 500 stocks from the S&P 500, looks back over the past year, and identifies the 100 lowest volatility stocks as measured by their price movement. And then it constructs a portfolio of those 100 stocks. And then it redoes it every quarter, it does that again. So they move forward one quarter, they look back over the prior 12 months, come up with the 100 least volatile stocks, and then rebalance the portfolio into those names. So it does revolve in and out of different stocks as the stocks become more volatile. They leave the strategy, and as they're the newer low vol stocks kind of replace them in the strategy. So it's a little different. The idea behind that is to, when we run into troubled times in the market, it has historically held up better than the traditional S&P 500. And we have some exhibits where we can take a look at that. It doesn't always work. So as I said, there isn't, a perfect investment plan out there. Everyone, every strategy, there's something that's good about it. There's something bad about it. And so we'll take a quick look at that. But that's kind of the idea behind it, is that it protects you on the downside. It gives up a little bit on the upside, at least in theory. Any questions about the two strategies we're looking at? One of the things we're looking at are the passive strategies, really trying to keep our costs low so that these would both be what I would say are very inexpensive from an asset management. I think we're roughly paying 10 basis points on the LS strategy, and that Comerica fund should come in a little bit below that.
Now, Chris, where is you were talking about basically the WAM policy also, is that correct?
So WAM and Comerica go hand in hand.
Okay.
So World Asset Management, or WAM, sorry about that. In my mind, they're interchangeable, but I recognize for you, you probably don't hear them that often. So World Asset Management is technically Comerica's passive investment arm. So
Okay.
that's when you hear me say WAM, I'm referring to this World Asset Management, and it's part of Comerica. They're going to basically be, you can see here, this is the current chart I'm showing here has how much is invested outside the US, and you can see basically it's all invested within the US. I realize it looks like they're pretty sharp points here on the chart. Those are where it gets to like 1 and 2%. This is one chart I did want to pause on. So there is, I would say, a distinct difference between the two strategies. The gray dots that you're looking at, or the gray ellipse, that represents your low vol strategy. And then the blue and black, the blue is technically that Comerica large cap index fund. The black is technically the S&P 500. You can see they're almost on top of each other. That's by design. They should be on top of one another. If you're trying to mimic that strategy, that's where you would hope you'd fall. But what you'll notice here is that the low vol strategy definitely has a value tilt to it. And it's also not quite as large. So when I say large, it's going to have, it's not having some of the exposure to those really large names, or if they do have exposure to them, it's not to the full weight. So if Apple represents, 4% of the index, it would only represent 1% if it is one of the low vol stocks within that low vol strategy. So those 100 stocks that they put in, they each put them in at 1%. Roughly, if I recall. So, and you can see it, so there is definitely kind of a value tilt towards the low vol. I do have some historical performance. The LS portfolio, you can see, goes back about 7 years. It has not quite kept pace with the large cap index. You'll note that the Comerica fund performs right in line with the S&P 500. That's by design. You can see over 10 years, it trails by 1 basis point. So it's 13.98 versus 13.99. And is it at the 7-year mark where we do have common numbers for all of them? You'll note that the low vol is done about 9.5, and it trails by about 2.5% there. So this is the one I wanted to kind of look at a little bit closer. This is the calendar year performance, and one of the ones I wanted to point to is like 2008. We actually had this strategy back in 2008, and the VEBA actually performed very well that year because we did not suffer the losses that the overall market had. Unfortunately, and I apologize, LS has not updated their data, so this is only through June of last year. So that's why if you look at the 2020, there is no LS number. That's because they hadn't updated since June 30th, and you'll note that at the top of the chart. I have a page after this with a little more data about the low vol strategy. What I wanted to point out though is like in first 6 months of last year, you'll see that the S&P was down about 3%. Remember, it was down about 30% in the matter of about a month. Kind of late February into March, the market sold off very strongly, over 30%, and then had a really strong comeback or rebound in May and in June, and that's where it ended. The low vol strategy did not protect us in that period of time. So you can see for the first 6 months, it was still down almost 14%, where the market had recovered most of their losses, and we're only down 3%. And that comes through for the full year, and you'll see that in a minute here. So this one here shows the low vol over the last year. I've taken out the LS strategy and replaced it with just a low vol strategy.
Chris, on these, where you show, I guess can you back up one screen there? Where you're showing these, the S&P 500 traditional versus the low vol, where would say this Comerica be on this list?
So the Comerica is that the blue dot. It's the S&P 500. If you remember over the last 10 years, they 1 basis point difference. I mean, they basically mirror the S&P 500. So
okay,
that Comerica strategy would be the blue dot. We had the Russell 1000. It's just a different large cap benchmark for comparison purposes. And as I just included that, you'll note that the blue circle and the black square basically are on top of each other, almost, you know, month in, month out, year in, year out.
okay, thanks.
So we do have some other exhibits in here. I don't think they're going to kind of shock you. This is so when, and I would kind of draw your attention down here. We went back to the LS and the Comerica strategies at this time, but what you'll see here is that low vol strategy, you know, a little less return and then a little less risk. So the further you're to the left, excuse me, the less risk as measured by the standard deviation. You know, ideally you want a strategy that's in the upper left-hand corner. We're talking about passive strategies here, so that generally is not going to happen. And the low vol strategy is performing kind of what you would expect. It has less volatility. It does come with a little less return though as well. Now I go back to just the indexes so that you can actually see the 10-year number here. So this is the, you know, the S&P compared to the S&P 500 low vol index, and exact same story here, that the low vol, a little less return, a little less risk over the 10-year period. So Any questions? So the recommendation we have is to move to that traditional S&P 500 strategy as managed by Comerica. I'll go back to the first page there. Like I said, we can get it for a very low cost. I want to say it's going to be like 5 basis points. I'm trying to get them to use the assets from the pension fund and combine them with the VEBA fund for fee negotiations. I'm still waiting to hear if they will do that on our behalf. And if that's the case, then we actually get a little bit more of a savings.
And that Comerica passive is the same as the World Asset Management?
Yes.
Okay. Do we have a motion to that effect? I'd make a motion to that effect. If I can get support.
Simpson, support.
It's been moved and it's been supported. Is there any discussion?
Yeah, I'm gonna go put my stuff in the house real quick. And then come over to our house. Daddy.
I'm sorry, I'm having a hard time hearing who that is.
I'm muting some lines. I'm getting some background noise here. There we go. Sorry.
Okay, no problem. So, you know, one thing I guess I do want to point out, Chris, is again, this transition that you're recommending from LSIA to the Comerica is basically something that has to be done. We really don't have a choice on making a movement at this time, correct?
Yes, that's correct. I mean, Ellis has basically told us they will not manage it. So we do definitely have to do something. It's more of a question, are we okay moving to this traditional S&P 500 from the low vol? World Estimate would be able to kind of do either one of those, or Comerica could do either one of the strategies. It would take us a little bit longer to get the recommendation for you for the low vol.
It actually looks like it's performed a little bit better than the LSIA anyway.
It has.
So, all right. Does anybody else have any questions on that? We do have a motion on the floor. It's been moved. It's been supported to follow those recommendations that Chris has made. Seeing no other questions, all those in favor signify by saying aye. Aye.
Aye.
Opposed? Motion carried.
So, just as a little point of, I think I heard in that motion that subject to Frank's review of the contracts. Is that correct?
I have no objections to that. To me, that's a default. So
I just want to make sure everyone's aware that we'll have your legal counsel review the contract for Comerica. I did negotiate with them on taking the securities in kind on your behalf. And the advantage to that is you won't be out of the market at all, and there won't be any transaction costs associated with selling the securities. So that would also be a benefit to you.
okay. Thank you very much. Is there any other business for this body?
Not at this time.
Thank you for attending this special meeting on such short notice. And at this point in time, we are adjourned.
Thank you, everyone.
Thank you.